What other types of investment risk exist? Imagine you're planting a garden. You know some seeds might grow into big, healthy plants, but others might not sprout at all. Investing is a lot like that. There are different risks that can affect how much money you make or lose. Let's look at some of these risks so you can understand what could happen when you invest. First, there is market risk. This is the chance that the overall value of investments like stocks or bonds can go up or down because of changes in the economy or the stock market. For example, if the economy slows down, stock prices might fall, and your investments could lose value. This risk affects almost all investments and can be hard to avoid completely. Next, interest rate risk mainly affects bonds. When interest rates go up, the value of existing bonds usually drops because new bonds pay more interest. If you decide to sell your bond before it reaches its maturity date, you might get less money than you paid for it. So, rising interest rates can make your bond investments less valuable. Then there is inflation risk, also called purchasing power risk. Inflation is when prices for things like food, clothes, and gas go up over time. If your investments don't grow faster than inflation, your money loses buying power. For example, if your investment grows by 2% but inflation is 3%, your money actually shrinks in value. Credit risk, or default risk, happens when you lend money to a company or government through bonds or loans. There's a chance they might not pay back the interest or the original amount. Bonds from stable governments usually have low credit risk, but bonds from companies with financial problems have higher risk. Business risk is about how well a specific company can make money. If a company faces problems like losing customers or high costs, its stock price might fall. This risk is unique to each company you invest in. Political risk involves changes in government, laws, or political stability in a country. If you invest in foreign companies or bonds, new taxes or trade restrictions can make your investments less profitable or even cause losses. Currency risk, also called exchange rate risk, affects investments in foreign countries. If the foreign currency loses value compared to your own, your investment might be worth less when you convert it back to your currency. Reinvestment risk is mostly for bonds or investments that pay interest or dividends. It's the chance that when you receive payments, you won't be able to reinvest that money at the same or higher interest rate. This can lower your overall returns over time. Finally, liquidity risk is the chance you can't sell your investment quickly without losing money. For example, real estate or some stocks might be hard to sell fast if you need cash urgently. Knowing about these risks helps you decide how to balance your investments. Usually, higher risk can mean higher rewards but also bigger chances of losing money. By understanding these risks, you can choose investments that fit your goals and how long you plan to keep your money invested. Spreading your money across different types of investments, called diversification, can help reduce some risks but not all. Being aware of these risks makes you a smarter investor and helps you build wealth over time.